Chapter 13: Production and Business Operations. There are three forms of production: extraction and cultivation, processing, and manufacturing. In extraction and cultivation, products are obtained from nature or grown using natural resources. Extraction and cultivation ensures that there is an available supply of natural resources and the crops, livestock, and other agriculture products needed. Processing involves changing and improving the form of another product. Few products are used exactly as they are found in nature or grown on farms. Most are processed in some way before they can be used. The last form of production is manufacturing. Manufacturing combines raw materials and processed goods into finished products. Either other businesses or final consumers use those finished products. Building a specific, unique product to meet the needs of each customer is done with custom manufacturing. Custom manufacturers make products ranging from concert halls to limousines to meet the particular design standards. The continuous process improvement increases the quality of work by reducing errors, inefficiencies, and waste. Rather than waiting for a problem to occur, processes are continuously reviewed with a goal of finding ways to improve them. Some of the steps in the continuous process improvement are: improve process quality, involve everyone, identify process activities, establish quality performance standards, select measurement tools, and monitor performance continuously. An operational plan identifies how work will be done, who will do it, and what resources will be needed. An operational plan for the production area of a factory determines when each product will be produced. It assigns production activities and determines the numbers of employees needed. Using technology to help manage operations will make planning and decision-making quicker. Collaboration software provides real-time communications capabilities by voice, text, and video. Chapter 14: Risk Management. Every day, people face different types of risks. Risk is the possibility of incurring a loss. You face many types of risk and possible losses. Some are very important, and some can have long-term effects. The first type of business risk is an economic risk, which can result in financial loss. The second type of risk is pure and speculative risk. A pure risk represents the chance of loss but no opportunity for gain. Speculative risks offer the chance either to gain or to lose. The third type of risk is controllable and uncontrollable. An controllable risk can be reduced or eliminated by actions you take. Uncontrollable risk cannot be reduced by your actions. A large number of people face a given risk, and the cost of possibility losses can be predicted, and it is called an insurable risk. If the risk is not common, it is known as an uninsurable risk. Property rights are the exclusive rights to possess and use property and its profits. This excludes everyone else from interfering with the use of this specific item. Insurance companies provide planned protection against economic losses. The company called an insurer agrees to take on certain economic risks and to pay for losses if they occur. Counterfeiting is the use of illegal intellectual property, patents, trademarks, and copyrights. For example, a company may change a product slightly and sell it in other countries, meaning they don't have to pay for all the development costs. Chapter 15: Consumers and Global Economy. Fraud happens when consumers are given false information in an effort to make a sale. Not all product information you receive can be expected to be perfectly accurate. To fight against unfair business practices, consumers united to demand fair treatment from businesses. This was the consumer movement. Because of this movement, public and private agencies, policies, laws, and regulations were developed to protect consumers from unfair practices. A unit price is a price per unit of measure. Most stores help consumers compare among various brands and sizes of the same product. Shelf labels show both the total price and the price of one standard measurement. Most customers use the decision-making steps when making a purchase. The first step is identifying your needs or wants. Be able to state clearly why you intend to buy something. Step 2 is knowing the choices available. These choices include price, quality, location, variety, reputation, and some other factors that you might want to take into consideration. Number 3 is to determine your desired satisfaction. You should develop answers to questions such as how much do I want to pay, the level of quality, and how long you're willing to wait for the item to arrive. Step 4 in the decision-making process is evaluating alternatives. At this stage, you will be shopping for products or services that could satisfy your needs. You will need to compare them in terms of criteria that you have made yourself. Step 5 is making the final decision. Decide whether or not to buy the product. Determine what product or service is most satisfying. You also need to decide which business you will be making the purchase from. The opposite of spending time and effort is buying too quickly and is called impulse buying. Impulse buying can be very bad and should be avoided. It happens often when an item is nicely displayed where customers are likely to see it. Chapter 16: Money Management and Financial Planning. Money management pertains to the day-to-day financial activities associated with using limited income to satisfy your unlimited needs and wants. Money management involves getting the most for your money through careful planning, saving, and spending. It involves making and using plans for that spending that you want to do. A financial plan is a report that summarizes your current financial conditions, acknowledges your financial needs, and sets a direction for your future finances. Financial planning includes evaluating one's financial position, setting financial goals, and guiding activities and resources towards reaching those goals. Everyone should have a carefully developed financial plan. Personal items of value are known as personal assets. Assets include such things as money in bank accounts, investments, furniture, clothing, vehicles, jewelry, and rare coins. A cash flow statement reports net wages and other income along with spending for a period, such as for a month. At the beginning of all cash flow statements, the report shows the cash inflow, or your income. Cash inflows is the money you have available to spend as a result of working or from other income, such as interest earned on your savings. A budget allows people to meet their personal goals with a system of saving and wise spending. Having a plan for saving will help you do the following: live within your income, make wise decisions, avoid credit problems, and plan for financial emergencies.